It's definitely what you'd like to see. Very, very much different than what we were seeing on like Monday, when we get this Monday gap up, and we're all kind of nervous about Monday gap ups, because will it hold type thing. So, and then as you mentioned, we also got that support right there at the 21-day moving average line. My biggest concern, and you and I were talking about this yesterday, is that it didn't pull back that much. I think, you had just a little bit over a 2% correction, if you want to call it a correction. Let's just say pullback in the NASDAQ composite. So, usually it takes a little bit more of a pullback for you to get more of a strong bounce. I mean, it's like Newton's law of physics in action here. And so the fact that we didn't come down that much just makes me think, I just wonder how much power we're going to have moving forward. Now, there can always be catalysts that, kind of change things. But, just based on the chart action, I'm still going to be involved, but maybe not being as aggressive, and maybe being a little bit quicker to take profits.
And Eric, as a longtime growth investor, talk to us about how the current market conditions have impacted your approach to trading as of late.
Well, it was interesting to see the market go down 5 days in a row. And we know our growth stocks can go down more than what the market does, and they did. But when you look at it, it's like the NASDAQ only went down like 2.62% from the peak to the trough, and the S&P was only like 2.5%. So it always feels worse than it sounds. And really, that's just a garden variety pullback, right? I mean, we could lose that much in a day, and a really bad day. So it didn't feel good. The way it impacted me was I did start to hedge a little bit with some options. I buy puts typically on my own stocks. I sometimes use the Chris Gessel approach, where you buy maybe a TQQQ put or a QQQ put. But sometimes I find, and it did happen in the last 2 weeks, where you might have your stocks going down and you buy that QQQ put or the TQQ put, and that goes up because Facebook, Google, Apple, Amazon, and Microsoft all went up, and your stocks went down. So you actually lost money on the hedge and on your stocks. So I tend to try to hedge with buying puts on my own stocks.
Yes, Chris using NASDAQ futures. We've also talked about using SQQQ, but that's really, Justin, before we start to see a pullback when we're getting extended. There's a lot of different ways that you can hedge, and Eric, really looking forward to digging in a little bit more and maybe finding some examples of those hedges that you've been using for your portfolio. Now, Dave, I want to turn to you and get your take on the market right now and how it's impacted your portfolio.
I'm fortunate to say that raising cash over the past week to roughly, I think I got to just shy of 20% cash in my main trading portfolio. And I'm really glad I did that, because it gave me an opportunity to participate in some new stocks. I've been starting to accumulate slowly in Palantir, PLTR. So thrilled that Eric wants to talk about that stock too, especially given his expertise alongside Eve and Kathy Donnelly, right, regarding new IPOs. So I think having cash right now, Ali, is a smart play, because it gives you flexibility. We don't know whether this uptrend will continue, but if it does, we'll be we can participate. And I'm very hesitant to go on margin at this point.
Well, we will continue to track the action in the major indexes throughout the show and talk more about how we may want to be positioning ourselves given that action, do a little scenario analysis as well. But now let's go ahead and take a look at MarketSmith. So I am now going to share that, and let's take a look at PagerDuty here. So Eric, I'd love to get your take on this stock. We've been talking a lot about how the software sector has really improved in the subgroups in the industry group rankings, and the desktop software group now at 8 out of 197, and PagerDuty here having a strong day yesterday with a gain of more than 4%.
Okay, well, let's take a look at it. If you could go to the weekly chart, that would help me a little bit.
Yeah, there we go.
Okay. The way I look at this stock is the first thing I do is always look at where is it at in its life cycle, because that tells me a little bit more about how I should invest, what kind of rules I should use, and how much I should invest. And when I look at PagerDuty, it's a relatively recent IPO. It came out in 2019. It had an initial rise, which we would call the IPO advance, and then it petered out. And like 91% of all IPOs, it eventually undercuts its IPO day one low, and this one did. It had a big correction. I mean, this was bigger than most. And it looks like that correction bottomed right around the COVID crash. So it then started to come back up, and it formed a nice uptrend. And then right there where you had the mouse was on that first base is the very first place after that uptrend after the COVID crash. It had a nice flat base there. And then it tried to break out once and then came back in. And then it looked like it had a really bad failed breakout. So maybe anybody who bought there would have been shaken out. And then it formed another base. And then that base was tighter and it looked better. And it finally broke out right about where your mouse is at. And then it had a nice rise. So that is what I would call a breakout of its first mature base after its institutional due diligence phase. That whole area from where it first went down into over here, the institutions are trying to determine, is this something we want to invest a lot of capital in? And it looks like they were accumulating it. And when it finally broke out, it now starts to do what we would call like its first advance out of the IDDP. And it had a nice run, and it peaked last, well, I guess earlier this year, maybe late February, like the rest of the market did. And then it formed another base. And this base, it looks like a much smoother, much more less volatile base. And it looks like it tried to break out, about 2 weeks ago, and pulled back. It's forming a nice handle. It broke above that rising trend line there, tried to break out, and it's acting okay. It certainly doesn't have the power where it takes off and runs, but this would be a stock where if I'm not in it already, I would put it on my watch list. It looks like it has enough volume, trades over $20 million a day. So that's institutional grade, in my opinion. And I'd be looking for an advance and heavy volume and break above this area where it's at right now.
Okay. So,
Hey, Erica,
yeah.
one of the things, I mean, of course, earnings are, very important with a lot of the, canceling stocks, and this one just doesn't have it yet, right? It does have the sales. This is something that we've seen a lot of stocks do very well, even though they don't have the earnings, but they generally do have that strong revenue growth. What is your take? How do you handle the stocks that don't have the earnings? Do you give it a pass?
Well, and frankly, yes, I would. And the reason is there are so many other recent IPOs that do have good charts and good sales growth, but they also have earnings. And so I'd be looking at something that had probably positive earnings, but see, this one also doesn't have a lot of institutional support. When you look at the institutions as growing, it's gone up the last 3 quarters in a row. It's up to 330 funds right